what is your business worth? And typically business owners want to know this when they're getting ready to sell their business or their exit planning. And there's a variety of different ways to determine the value of your business. For the most part, in the small market, the smaller middle market, businesses are bought and sold for a multiple of what they earn. And so if you're trying to determine what your business is worth or what buyers will offer on your business, now of course there's a buyer for everything and they're all different kinds of buyers, but for the most part, businesses are valued for a multiple of what they are earning. And so you want to figure out what the earnings of your business is. Now, it's not necessarily just your profits, and it's not going to be based off of revenue. Majority of the times, it's going to be based off of SDE, which is seller's discretionary earnings, or EBITDA, which is earnings before interest, taxes, depreciation, amortization. And so you can do a rough back of the napkin valuation, as they call it. You can hire a business broker to get a broker's opinion on the value of your business, or you can actually go and pay for a certified business appraisal. These are going to cost you a few $1,000s, just depending on the size and the complexity of your business. But if you want to figure out a rough back of the napkin valuation or enterprise value or listing price on your business, you're going to want to take a look at your earnings in your business. Now, as you can imagine, there's so many different variables that are going to come into play. I'm just going to keep this extremely high level. You're going to want to look back on the last 3 years of your earnings. So just look at your profit and loss statements. Now, lenders and buyers are typically going to look at your tax returns to get a more accurate assessment. But they should correlate fairly closely to your profit and loss statements. So I would look at the last 3 years of your P&L statements, and the reason why it's 3 years is because banks, and the reason why banks are important is because buyers are going to use banks, they're going to use an SBA loan usually to acquire a business, and a bank is going to look at the last 3 years of that business and target. And so you want to make sure as the business owner that your last 3 years, sometimes going back 5 years, are looking good and they are clean. And so I would pull the last 3 years of your P&Ls and just look at your bottom line earnings. And if you can figure out what your seller discretionary earnings, which is usually going to be your net income plus any owner benefits. So if you're paying yourself a salary, distributions, or if you have any discretionary spending, personal discretionary spending through that business. So for example, if you're running your personal car through the business, or maybe you had a one-time irregular payment, maybe a legal fee, right? Meals and entertainment, items like that, discretionary spending like that can be added to your profit, your net income. And that will be your seller discretionary earnings. So that's your earnings metric. And then you apply a multiple to that earnings metric. Now, the best way to really do this is take an average of that seller discretionary earnings over 3 years. So don't just take last year, and then don't just take the best performing year of those 3. Take an average of all 3, and you preferably would want to show growth year over year over year. That's going to look the most appealing for buyers. But you're going to want to take an average of those last 3, and let's say your seller discretionary earnings is $1 million, or your EBITDA is $1 million. Usually you'll see the term SDE used more for businesses earning under $1 million, is you'll see that term. Once you start getting over $1 million in that earnings, you'll start using EBITDA, you'll start hearing EBITDA. And these are just metrics for buyers to compare business to business and get a sense of the profitability for each business they're looking at, because they're typically looking at several different businesses. So you've probably heard of these terms before, but you're going to want to figure out that earnings metric, as I said, STE or EBITDA. And let's say it's $1 million, right? And your EBITDA is $1 million. So that's your earnings before you pay interest, taxes, depreciation, amortization. And when you ask about, well, what about the discretionary spending that you talked about in the SDE? You can add that back to your EBITDA. So if you're running personal car, as I mentioned, meals, entertainment, maybe one-off expenses, you can add that back to the EBITDA. That's your adjusted EBITDA. So it's essentially the same thing, right? And then you're going to apply a multiple to that. And so industry multiples can vary. You're usually going to see anywhere from a 2 to a 4, maybe creeping up to a 5. Now, what drives the multiple is typically the main driver is going to be the earnings of the business. And so anything under $1 million, usually around 2 to a 4, unless you're in a very highly desirable industry like tech or SaaS, something like that. That's when you might see a little bit more. But I would just do some research on your current industry. If you're in manufacturing, landscaping, whatever it is that you're in, a quick Google search should give you a pretty good idea of where multiples are falling for businesses in your size of earnings. Call it $1 million of earnings. Let's apply a 3 multiple to that just for easy math. So 3 times $1 million is $3 million, and that's a rough, very, very rough back of the napkin valuation of your business. This doesn't include any inventory, furniture, fixture, and equipment, any other tangible, intangible assets. Maybe you own the real estate that you're looking to sell as well. So all of those other assets will be added on top of that as well. But again, the price is what the buyer is willing to offer and what you're willing to accept, but this will give you a good idea of where your business can fall. So that's how you find the value of your business. That's what the value of your business is. And again, so many other factors come into play here, but if you want to do a rough back of the napkin approach, that's a good way to find out where your business could sell for at what price. So if you have any questions on this, let me know. I'm happy to answer them in the comments, and I appreciate you watching.